What if I told you that the most powerful money network in the world just got challenged inside a boardroom in Frankfurt? For decades, the global banking system has relied on one giant messaging network, Society for Worldwide Interbank Financial Telecommunication, better known as SWIFT. It has been the backbone of international money transfers since the 1970s. Almost every major bank uses it. It moves trillions of dollars every single day, and for a long time, nobody questioned its dominance. But here's the problem. SWIFT was built in a different era. It was designed for a slower world, a world without blockchain, without instant settlement, and without digital assets. Today, when you send a cross-border bank transfer, it can still take 3 to 5 business days. The money doesn't actually move instantly. It passes through multiple intermediary banks. Each one takes a fee, each one adds delay, and during that time, billions of dollars sit idle in pre-funded accounts across the world. Now something has changed. In a move that sent shockwaves across Europe's financial sector, Deutsche Bank, a banking giant with over $1 trillion in assets, officially pivoted toward infrastructure built by Ripple. This is not a small pilot program. This is not a vague press release. This is a strategic shift toward next-generation global payment rails powered by the XRP ledger. Let's break down why this matters. Under the traditional SWIFT system, a payment can bounce between 3, 4, sometimes even 5 different correspondent banks before it reaches its destination. That creates friction, it creates cost, it creates trapped liquidity. Banks must hold billions of dollars in foreign accounts, known as nostro and vostro accounts, just to make sure transactions settle properly. That money sits there doing nothing. It cannot be invested. It cannot be deployed. It is essentially frozen capital. Now compare that to Ripple's infrastructure. Instead of days, settlement can happen in 3 to 5 seconds. Instead of multiple middlemen, transactions can move directly between institutions. Instead of locking billions in dormant accounts, liquidity can be sourced on demand using a digital bridge asset. This shift is not about hype, it is about efficiency. Reports suggest that by removing layers of intermediaries, major banks could reduce operational costs by up to 30%. For a $1 trillion institution like Deutsche Bank, that is not pocket change. That is billions in potential savings. But here's what makes this moment historic. When a major global bank adopts blockchain-based infrastructure, it validates the technology at the highest institutional level. It sends a signal to the entire financial world that the old system is no longer untouchable. We are entering a phase where blockchain is not being tested in labs. It is being deployed in production environments, real money, real settlement, real institutions, and this is happening at the same time that corporate America is moving toward digital asset exposure. By 2026, analysts expect nearly half of Fortune 500 companies to have some form of crypto strategy, whether that means holding tokenized assets, stablecoins, or blockchain-based treasury products. The focus is no longer just on faster messaging. It is shifting toward real asset movement on-chain. That creates a new kind of pressure. When infrastructure upgrades, assets eventually follow. And when trillions of dollars begin flowing through new digital rails, demand for liquidity solutions grows alongside it. This is where the conversation moves from speculation to utility. For years, digital assets were driven mostly by retail excitement. Now we are watching institutions build the plumbing for a new financial system. The difference is massive. Retail speculation creates volatility. Institutional infrastructure creates durability. The key question is no longer, does this technology work? The question is, how fast can global banks transition before they fall behind? Deutsche Bank's move suggests the answer may be faster than most people expected. And if this is only the beginning, then what we are witnessing right now may not just be another crypto cycle. It may be the early stages of a full transformation in how global value moves. To understand how big this shift really is, we need to talk about something most retail investors never hear about: trapped liquidity. Right now, the global banking system is built on something called correspondent banking. When Bank A in one country wants to send money to Bank B in another country, it usually cannot do it directly. Instead, it relies on a chain of intermediary banks that hold accounts with each other. These accounts are known as nostro and vostro accounts. Here is the hidden problem. Banks must pre-fund these accounts with massive amounts of capital. Billions of dollars sit in foreign vaults across the world just waiting to be used for settlement. That money is not earning meaningful yield. It is not being invested. It is not growing. It is simply parked there as a safety buffer to keep the system functioning. Estimates suggest that nearly $20 trillion globally is locked in this inefficient structure. Think about that for a second. $20 trillion sitting idle just to make sure payments clear. This is what people people mean when they say ghost money. It exists, but it is not working. It is trapped in layers of outdated infrastructure designed for the 1970s. Now imagine what happens when that capital no longer needs to be parked. When banks move to blockchain-based settlement through infrastructure like Ripple's network, they no longer need to maintain thousands of dormant foreign accounts. Instead of pre-funding liquidity, they can source liquidity on demand in real time. That changes everything. For a bank like Deutsche Bank, this is not just about speed, it is about capital efficiency. If you can free up billions of dollars from idle accounts, that money can be redeployed into loans, investments, or balance sheet optimization. Efficiency at that level increases profitability, and institutions move fast when profitability improves. This is why the pivot toward Ripple infrastructure is so powerful. It is not experimental anymore. It is strategic. It represents a shift from messaging money to actually moving value. Under traditional Swift rails, transactions can take days to finalize. During that time, capital is in limbo. With the XRP ledger, settlement can reach finality in seconds. Finality is important. When a transaction reaches finality, it is done. No clawbacks, no waiting, no uncertainty. That certainty reduces counterparty risk and reduces operational complexity. For global banks managing billions in daily flows, certainty equals stability. Now let's talk about network effects. When one major institution adopts a new system, it gains efficiency. But when multiple institutions join the same network, something bigger happens. Liquidity pools grow, transaction costs drop further, settlement becomes smoother. Each new participant strengthens the entire system. This is how infrastructure transitions happen. First, early adopters test it, then major institutions integrate it. Then the network effect makes it economically irrational to stay on the old system. We are moving from pilot programs to deployment phase. Trading activity on the XRP ledger has already surged into multi-billion-dollar 24-hour volumes in early 2026. This is not just retail traders speculating. Automated institutional systems are plugging into these rails. Market makers are providing liquidity, custody services are expanding, the plumbing is being built for scale. And here's the key shift in narrative. For years, critics argued that blockchain was too slow, too risky, or too unregulated for serious finance. But as compliance layers improve and regulated custody becomes standard, those objections are losing strength. Banks are no longer asking, does this technology work? They are asking, how much capital can we unlock if we adopt it? When trillions of dollars are potentially freed from correspondent banking layers, adoption stops being ideological. It becomes mathematical. The industry is also expanding beyond payments. Tokenized treasury bills, stablecoins, on-chain settlement of real-world assets, these are no longer concepts. They are being implemented. The rails are evolving from simple payment channels into full digital asset infrastructure. That is why this moment feels different from past crypto cycles. In the past, speculation came first and infrastructure came later. Now infrastructure is coming first. If even a fraction of that $20 trillion liquidity trap begins to move onto blockchain rails, the impact will ripple across global finance. Capital becomes more fluid. Settlement becomes real-time, operational costs decline, and balance sheets become more efficient. The old system relied on friction, the new system thrives on speed, and once efficiency becomes visible at scale, it is very difficult to reverse. This is not about replacing banks, it is about upgrading them. And upgrades, once proven, tend to spread quickly. One of the biggest hurdles for crypto adoption by major institutions has always been regulation. For years, banks and asset managers wanted to participate, but they couldn't fully commit. They feared running afoul of regulators or exposing themselves to legal uncertainty. XRP, in particular, was at the center of a storm. The Ripple SEC case loomed like a dark cloud over every institutional conversation. Was XRP a security? Could banks legally hold it or settle payments with it? These questions kept the smart money waiting on the sidelines. That changed with the resolution of the SEC case in 2025. Ripple did not just survive, it emerged with a clean slate. A final civil penalty of $50 million, far lower than the original $2 billion demand, cleared the way for Ripple to resume institutional operations without fear of federal suspension. The legal clarity effectively security-proofed XRP for both retail and institutional markets. This was a turning point. Once the regulatory overhang was removed, Ripple could focus entirely on building infrastructure and growing institutional adoption. In early 2026, the company secured regulated licenses in key markets like the UK, allowing it to provide payment services directly to large financial institutions under official oversight. Now the doors are open, and institutional money is flowing in fast. Over $147 billion has already been deployed into spot XRP ETFs from major firms like Bitwise Asset Management and Canary Capital. This is not retail FOMO. These are massive sticky inflows, money that stays in the system for months or years, creating sustained demand for XRP. Think about how this changes the market dynamic. Retail traders are used to volatility and speculation. Institutional flows, however, act like anchors. They remove supply from exchanges, lock it in custody, and force a structural price floor. The $1.42 price floor you see forming in early 2026 is a direct result of these inflows. Smart money is moving first, and retail follows. And it doesn't stop there. The approval of spot XRP ETFs has created a roadmap for even more institutional participation. Pending ETF applications are expected to clear in early 2026, opening the floodgates for pension funds, family offices, and global wealth managers. Each large allocation removes XRP from the open market, increasing scarcity and creating a powerful supply-demand imbalance. This is exactly why Deutsche Bank, along with other leading institutions, is integrating Ripple's network. They are no longer experimenting. They are deploying real capital with legal certainty using regulated channels. The scale is unprecedented. We're not talking about a few million here or there. We are talking billions in assets under management flowing onto a ledger designed for speed, transparency, and reliability. This is the kind of capital that can move markets, not just prices. The narrative is also shifting. XRP is no longer just a crypto asset to trade. It is now a ticker symbol on a Bloomberg terminal. Banks are using it as a settlement layer. Wealth managers are adding it to diversified portfolios. ETFs are providing regulated access. The distinction between traditional finance and digital assets is disappearing. Institutional adoption drives another effect: confidence. When banks see other banks moving onto a blockchain network, the incentive to join grows. The network effect begins to take hold. More participants mean more liquidity. More liquidity means faster settlement and lower costs. Soon, it becomes economically irrational for a major institution to stay on outdated rails like SWIFT. We are seeing this play out in real time. Infrastructure is being built. Regulatory certainty exists. Institutional flows are significant, and the math is clear. As adoption rises, supply tightens, and liquidity locks in. This is why 2026 is different from previous crypto cycles. It is no longer about hype. It is about utility, regulatory clarity, and real-world integration. The question for investors now is simple. Are you positioned before these institutional gates fully open, or will you watch as trillions of dollars move onto blockchain rails without you? While the West debated regulations and adoption, Japan quietly built the future of payments. One of the clearest examples of real-world blockchain integration is SBI Holdings. SBI has long championed XRP as a bridge asset for cross-border payments. In early 2026, the company took a major step by fully integrating XRP into live banking transactions across its network. This isn't a pilot, this is a nationwide deployment. Japanese banks are now sending real money in real time across borders using the XRP ledger. Payments that once took 3 or 4 days now settle in seconds. The implications are massive. Japan, a G7 economy, is now operating one of the first national-scale blockchain payment systems. This is the kind of proof of concept that global financial institutions were waiting for. It validates that XRP can handle not only isolated bank settlements, but also entire payment flows at a national scale. And Japan isn't acting alone. Global payment giants like MasterCard are experimenting with XRP for card payments. By tapping into the ledger, they can settle consumer transactions faster, cheaper, and more securely than traditional networks allow. Imagine a world where sending money internationally or paying for purchases across borders happens instantly. That's no longer theoretical. It's happening right now in Asia. This creates a network effect. Every institution that joins increases liquidity and strengthens the system. Each transaction removes XRP from circulation due to the ledger's built-in burn mechanism, slowly decreasing supply while demand rises. This makes XRP increasingly scarce and valuable as more banks and payment providers adopt it. Japan's integration also shows how regulated adoption works in practice. Banks follow strict KYC and AML rules while using XRP for liquidity management. This is a real-world example of blockchain technology coexisting with compliance, a critical requirement for global adoption. For investors, this is a major turning point. The narrative is shifting from crypto might work to crypto is already working. With trillions in potential transaction volume and pilot programs scaling to national levels, adoption is no longer speculative. It's structural. What this also demonstrates is speed combined with scale. Legacy systems are slow and expensive. Every second of delay costs banks billions in idle capital. With XRP, settlement happens in seconds, freeing up liquidity, cutting costs, and making financial systems more efficient. The West will follow. Once regulators see functioning examples like Japan combined with compliance-ready systems, they cannot ignore the efficiencies. Financial institutions around the world are watching closely. The momentum is building, and the adoption wave is just beginning. But there's more. With companies like MasterCard entering the ecosystem, XRP isn't just for banks anymore, it's for everyday consumers. International payments, card transactions, and merchant settlements can all benefit from blockchain speed and security. The ledger is moving from niche banking applications to mainstream financial infrastructure. In short, Japan is proving that XRP can handle real-world scale. Global giants are proving that payments, trading, and liquidity management can work on-chain. And the math is simple. The more participants adopt, the stronger the network becomes. Liquidity pools grow, settlement speeds improve, and capital efficiency rises across the board. This is the turning point where XRP moves from being a niche crypto asset to a core component of global financial infrastructure. As XRP adoption grows, the ecosystem is evolving beyond just payments. Ripple is building tools to make the ledger a full-service financial infrastructure for institutions. Two key innovations leading this change are RLUSD, a USD-backed stablecoin, and the XLS66 lending protocol. RLUSD acts as a complementary liquidity layer. Banks and large corporations can now move value with confidence, knowing that they have access to a stable, regulated asset alongside XRP's bridge functionality. It's not replacing XRP, it's enhancing it. Think of it as a dual system: fast, high-speed settlement with XRP and predictable, stable value movement with RLUSD. For banks like Deutsche Bank, this provides flexibility and reduces volatility risks in cross-border payments. Then comes XLS66. This protocol allows institutions to lend and borrow directly on the XRP ledger. Unlike other blockchains that rely on third-party smart contracts, XLS66 is hard-coded into the ledger, making it more secure and resilient. It introduces real DeFi functionality: lending, credit management, and on-chain yield generation, while keeping compliance and regulatory requirements in mind. This expansion is exciting but comes with challenges. Every new feature adds complexity. Critics worry that adding lending and DeFi capabilities could clog the network or slow down transaction speeds. After all, one of XRP Ledger's strongest selling points is finality in 3 through 5 seconds. Can it maintain that speed as more financial instruments move on-chain? That's the balance Ripple is working to strike: innovation versus simplicity. Liquidity is another key factor. For a lending protocol like XLS66 to function at institutional scale, the ledger needs deep pools of capital. If total value locked, TVL, isn't sufficient, lending features could sit idle, creating risk that the network's new capabilities are underutilized. Ripple is addressing this with partnerships and regulatory-ready infrastructure to ensure high liquidity participation. Beyond technical hurdles, compliance is front and center. Banks and global institutions require KYC and AML adherence. XRP's ecosystem is now designed with permissioned exchanges and protocols that meet these requirements. That means large-scale adoption is possible without violating regulations. This is a huge step forward compared to early blockchain experiments. The bigger picture: Ripple is turning the ledger into a complete institutional-grade system. Payments, liquidity, lending, stablecoins, and tokenized assets, all under one network. This is no longer just a settlement layer. It's a modular financial infrastructure designed to handle trillions of dollars globally. From an investor's perspective, this phase is critical. The ledger's growing capabilities, combined with regulatory clarity and institutional adoption, are creating structural demand for XRP. Every transaction, lending activity, and stablecoin settlement strengthens network utility. And because XRP is deflationary, the more it is used, the less supply remains, creating a natural scarcity mechanism. We are at the intersection of innovation and adoption. Ripple is proving that blockchain can be more than hype. It can be a full-scale financial system capable of handling payments, lending, and treasury management at institutional speed and scale.